Right now, somewhere in the world, millions of people are watching stock prices move up and down, feeling excitement when prices rise, fear when they fall, and confusion most of the time. But here's the uncomfortable truth. Most people in the market are not investing. They are reacting. They are guessing. They are hoping. And hope is not a financial strategy. If you've ever felt anxious checking your portfolio, if you've ever wondered whether you bought at the wrong time, if you've ever chased a stock because everyone else was talking about it, then what you're about to learn will fundamentally change how you see money, markets, and wealth. Because real investing is not about predicting the future. It is not about finding the next big thing. And it is definitely not about getting rich quickly. Real investing is about thinking differently from the crowd. It is about staying calm when others panic. It is about understanding value when others only see price. The principles you're about to learn were built on decades of market observation, refined through crashes, bubbles, recessions, and booms. And if you truly understand them, you stop being a participant in market chaos and start becoming an owner of wealth-building systems. This is not just about stocks. This is about mindset. This is about discipline. This is about learning how to make rational decisions in an emotional world. Let's begin. Chapter 1. Think like an owner. Buy businesses, not tickers. Most people enter the stock market through price. They see numbers moving. Green means good. Red means bad. News headlines talk about gains, crashes, rallies, and corrections. Over time, this conditions investors to think of stocks as lottery tickets that move up and down based on luck, news, or timing. But real investing begins when you stop seeing stocks as symbols and start seeing them as pieces of real businesses. When you buy a share of a company, you are not buying a flashing number on a screen. You are buying a small portion of a living, operating organization. That organization has employees, products, customers, leadership, strategy, strengths, and weaknesses. It produces value, or fails to. The stock price is only a reflection of what the market believes that business is worth at any given moment. But the business itself continues operating regardless of daily price movement. This shift in thinking changes everything. When you think like an owner, you stop reacting emotionally to price fluctuations. If you own an entire restaurant, you would not panic if someone offered to buy it at a lower price tomorrow. You would evaluate whether the restaurant is still profitable, whether customers are still coming, whether costs are manageable, and whether the long-term outlook is strong. Public markets simply give you constant price offers for businesses you partially own. Real investors ask business questions, not price questions. They ask, does this company solve a real problem? Does it provide something people need or strongly want? Is demand likely to exist 5 or 10 years from now? Businesses that solve durable problems often survive economic cycles better than businesses dependent on temporary trends. Long-term investors focus on sustainability, not popularity. Cash flow becomes a key focus. Profit can sometimes be manipulated through accounting methods, but cash flow is harder to fake. Cash flow tells you whether a business is truly generating money after expenses. Strong, consistent cash flow often signals business strength. Weak or unstable cash flow signals fragility. Competitive advantage is another major factor. Some businesses are easily replaced. Others build protective barriers. Brand strength, network effects, patents, cost advantages, or customer loyalty. These advantages protect profits from competitors. When competition cannot easily destroy profits, long-term value becomes more stable. Management quality also matters deeply. Even strong businesses can fail under poor leadership. Strong management allocates capital wisely, avoids unnecessary risk, and plans long-term. Weak management chases trends over expands or prioritizes short-term stock price over long-term business health. Industry durability matters as well. Some industries change rapidly. Others remain stable for decades. Durable industries often allow businesses to plan long-term investments and maintain steady demand. Rapidly changing industries can create huge winners, but also huge failures. Thinking like an owner also changes how you react during market volatility. When prices drop, most investors panic because they think they're losing money. Owners think differently. If the business remains strong, a lower price simply means a cheaper ownership opportunity. Imagine owning a farm. If farmland prices drop temporarily but crop production remains strong, the farm would still produce value. Public markets simply allow constant repricing. That repricing often reflects emotion, not reality. Markets are emotional machines in the short term and weigh machines in the long term. Short-term prices reflect fear, excitement, speculation, and headlines. Long-term prices reflect business performance. Owners focus on long-term weighing, not short-term voting. This mindset reduces stress dramatically. You stop feeling forced to react daily. You stop checking prices constantly. You focus on business performance indicators instead. Earnings growth, revenue stability, margin expansion, and capital efficiency. Thinking like an owner also prevents speculation traps. Many investors buy stocks simply because prices are rising. Rising price does not guarantee business strength. It often reflects crowd psychology. Owners care about value creation, not popularity. Ownership thinking also encourages patience. Businesses grow over years, not days. Compounding requires time. If you constantly buy and sell based on price movement, you interrupt compounding. Owners allow compounding to work. Ownership thinking also reduces noise sensitivity. News cycles focus on drama because drama attracts attention, but most news has little long-term business impact. Owners filter noise and focus on fundamentals. This shift from trader mindset to owner mindset is one of the biggest transitions in investing. Traders focus on timing price movements. Owners focus on owning value-producing assets over time. You don't need to predict tomorrow's price. You need to evaluate long-term business strength. Ownership thinking also changes how you measure success. Instead of measuring daily portfolio value, you measure business growth, earnings growth, and value creation. If the business becomes stronger, temporary price drops become less threatening. If the business becomes weaker, price increases become less comforting. Ownership thinking also creates emotional independence. When you understand a business deeply, you rely less on market opinions. Market opinions change daily. Business fundamentals change slowly. Slow-changing variables are more reliable than fast-changing emotions. Most importantly, ownership thinking aligns investing with reality. Businesses create wealth. Prices reflect perception of that wealth. When perception disconnects from reality, opportunity appears. Real investing is not about predicting crowds. It is about understanding businesses better than crowds. When you truly adopt ownership thinking, the market becomes less stressful, less confusing, and less emotional. You stop chasing price. You start evaluating value. And that shift, from price watcher to business evaluator, is where real investing begins. When you begin to think like an owner, something subtle but powerful changes in how you see risk. Most people believe risk is price movement. If the price goes down, they feel risk is increasing. If the price goes up, they feel risk is decreasing. But real business owners understand something very different. Risk is not price volatility. Risk is permanent loss of capital caused by business failure, poor management, or structural industry decline. Imagine owning a small manufacturing company. If someone offered to buy it for 20% less than last year's valuation, that does not automatically mean your company became worse. Maybe market sentiment changed. Maybe interest rates changed. Maybe investors became fearful. But if your company still produces quality products, still has loyal customers, and still generates profit, then the business value may not have changed much at all. Public markets create daily price visibility, and that visibility tricks investors into thinking price equals value. But price is simply what someone is willing to pay at a specific moment. Value is what the business actually produces over time. Owners care about value. Traders obsess over price. When you focus on business value, your analysis becomes more grounded. You begin studying revenue growth trends instead of price charts. You study profit margins instead of momentum indicators. You study return on capital instead of social media hype. This moves you from emotional decision-making to evidence-based decision-making. Another major shift happens in how you view time. Traders live in short time frames, hours, days, weeks. Owners live in long time frames, years, sometimes decades. Businesses take time to scale. New products take time to gain market adoption. Strategic investments take time to produce results. If you constantly measure business performance in days, you will almost always feel uncertain. Long-term thinking also allows you to benefit from compounding. Compounding is not dramatic at first. It feels slow, but over long periods, compounding becomes extremely powerful. Businesses that consistently reinvest profits into growth can multiply value dramatically over time, but only if investors allow time to work. Ownership thinking also changes how you interpret bad news. Short-term investors panic when negative news appears. Owners ask deeper questions. Does this news permanently damage the business model? Does it destroy long-term demand? Or is it temporary noise? Many short-term problems do not change long-term business value. For example, companies may face temporary supply chain issues, short-term demand slowdowns, or regulatory uncertainty. These may affect quarterly results, but they do not always destroy long-term business strength. Owners separate temporary disruption from permanent damage. Ownership thinking also requires intellectual honesty. Not every business is strong. Some businesses have weak competitive positions. Some industries decline permanently. Owners must be willing to recognize when business quality deteriorates. Ownership thinking is not blind loyalty. It is rational evaluation. You must be willing to ask hard questions. Is revenue growth real or artificially boosted? Is debt manageable or dangerous? Is management transparent or promotional? Are profits sustainable or temporary? These questions protect long-term capital. Another important part of ownership thinking is understanding capital allocation. Great businesses generate cash. Great management teams allocate that cash intelligently, reinvesting in growth, reducing debt, buying back shares wisely, or returning dividends to shareholders. Poor capital allocation can destroy even strong businesses. Ownership thinking also reduces the temptation to constantly trade. Every trade creates friction, fees, taxes, and emotional mistakes. Constant trading also increases the chance of buying high and selling low. Owners trade rarely because business fundamentals change slowly. This does not mean you never sell. It means you sell for business reasons, not emotional reasons. You sell if business fundamentals deteriorate, if valuation becomes irrationally high, or if better opportunities exist. But you do not sell simply because price dropped temporarily. Ownership thinking also improves portfolio concentration decisions. If you deeply understand a few businesses, you may invest more confidently in them. If you do not understand a business well, you should reduce exposure. Understanding drives conviction. Conviction supports emotional stability during volatility. Another powerful benefit of ownership thinking is reduced stress. When you know why you own something, price movement becomes less emotionally intense. Uncertainty creates stress. Understanding reduces uncertainty. Ownership thinking also improves learning speed. When you study businesses deeply, you naturally learn about industries, economics, consumer behavior, and management strategy. Investing becomes an education engine. Ownership thinking also aligns with how real wealth is created historically. Most great fortunes came from owning productive assets, businesses, land, or intellectual property. Trading price movements rarely creates durable wealth. Ownership of value-producing systems does. Ownership thinking also helps you ignore market noise. Financial media thrives on urgency. Headlines create emotional reactions. Owners filter noise and focus on data. Data changes slowly. Headlines change hourly. Another important truth: you do not need to understand every industry. In fact, trying to understand everything often leads to shallow knowledge. Deep understanding of fewer businesses often creates better results than shallow understanding of many. Ownership thinking also requires humility. Even great investors make mistakes. Businesses change. Markets evolve. Continuous learning remains essential. When you fully adopt ownership thinking, you stop seeing the stock market as a casino. You start seeing it as a marketplace for buying partial ownership in real economic engines. And when you consistently evaluate businesses instead of reacting to prices, you move closer to the core principle of intelligent investing. Rational decisions made in an emotional environment. That is how long-term investors separate themselves from the crowd, not through prediction, but through perspective. Over time, thinking like an owner reshapes how you interact with uncertainty. Most investors fear uncertainty because they do not understand what they own. When you do not understand the business behind a stock, every price movement feels dangerous. But when you understand how a company makes money, who its customers are, what risks it faces, and how it competes, uncertainty becomes more manageable. Owners do not eliminate uncertainty. They learn to operate within it. Every business faces unknowns, economic cycles, technological changes, regulation shifts, and competitive threats. The goal is not to find businesses with zero risk. The goal is to find businesses where risks are understandable, measurable, and survivable. This is where business durability becomes extremely important. Durable businesses usually share certain characteristics. They often sell products or services people need regularly. They often have pricing power, meaning they can raise prices without losing customers easily. They often have brand strength, cost advantages, or network effects that make competition difficult. For example, companies that provide essential infrastructure, widely used software, or daily consumer necessities often demonstrate stronger durability than companies dependent on short-term trends. Trends can create rapid growth, but they can disappear just as quickly. Thinking like an owner also changes how you interpret growth. Many investors chase fast-growing companies without asking whether that growth is sustainable. Owners ask deeper questions. Is growth driven by real customer demand or temporary market excitement? Is growth profitable, or is the company losing money to expand quickly? Growth without profitability often requires constant external funding, which creates hidden risk. Owners also focus heavily on balance sheet strength. A strong balance sheet means a company has enough cash or manageable debt levels to survive economic downturns. Companies with high debt may perform well during good economic periods, but struggle when conditions worsen. Debt is not always bad, but debt without stable cash flow can be dangerous. Owners analyze debt relative to earnings power. They ask whether the company can comfortably pay interest even during weaker periods. Thinking like an owner also builds patience with market cycles. Markets move in emotional waves, optimism, excitement, fear, and pessimism. Businesses, however, operate continuously. Sales continue. Products ship. Services are delivered. Long-term investors learn to separate emotional cycles from operational reality. Another shift happens in how you handle opportunity. Many investors feel pressure to always be invested in something. Owners are comfortable waiting. If no businesses are available at attractive valuations, waiting becomes a rational decision. Cash is not failure. Cash is optionality. Optionality means you have the ability to act when true opportunity appears. Markets regularly create mispricing, but you must have capital available to use those moments. Ownership thinking also encourages studying management behavior over time. Management teams reveal their true priorities through actions, not presentations. Do they invest wisely? Do they avoid unnecessary risk? Do they communicate honestly during difficult periods? Owners study leadership track records, not just future promises. Another key aspect is capital efficiency. Strong businesses often generate high returns on invested capital. This means they can grow without constantly needing new money. High capital efficiency allows compounding to accelerate internally. Ownership thinking also changes how you interpret market crashes. Market crashes feel terrifying to short-term investors. Owners see them as stress tests. If you understand the business and believe in its long-term survival, Lower prices may represent opportunity rather than danger. Of course, this requires careful analysis. Not every falling stock is an opportunity. Some businesses decline permanently. Ownership thinking requires continuous reevaluation of business fundamentals. Thinking like an owner also aligns with psychological stability. Emotional investing creates constant stress. Rational investing creates structured decision-making. Structured decision-making reduces emotional fatigue. Another long-term benefit is learning pattern recognition. Over time, you begin noticing which business models succeed consistently and which fail repeatedly. You recognize warning signs earlier. You recognize quality faster. Experience compounds just like capital. Ownership thinking also protects against hype cycles. Every decade produces new investment trends. Some become revolutionary. Many collapse. Owners ask whether the business model creates durable cash flow or depends on speculation. Ownership thinking also improves portfolio construction. Instead of chasing maximum return, owners build portfolios designed to survive. Survival allows compounding to work. Compounding creates real wealth. Many investors fail not because they choose bad businesses, but because they react emotionally during volatility. Ownership thinking strengthens emotional discipline because decisions are based on understanding, not fear. Another important truth: ownership thinking is simple but not easy. It requires patience when others chase excitement. It requires calm during panic. It requires independent thinking during crowd behavior. Over time, ownership thinking transforms investing from stressful guessing into structured decision-making. You begin evaluating businesses the way private investors, venture capitalists, and long-term capital allocators do. You ask, does this business create real value? Is that value durable? Is management trustworthy? Is the price reasonable relative to long-term value? If those answers are strong, temporary market volatility becomes less important. And this is where intelligent investing truly begins. Not with predictions, not with timing, but with ownership mindset. Because wealth is rarely built by reacting to price. It is built by owning value-producing assets long enough for compounding to work. And once you truly think like an owner, you stop chasing the market and start letting the market serve you. Chapter 2: Intrinsic Value and Margin of Safety. The Mathematics of Protection. If thinking like an owner changes how you see what you buy, intrinsic value changes how you decide what something is truly worth. And margin of safety changes how you protect yourself when you are wrong. Because in investing, you will be wrong sometimes. Even the greatest investors are wrong regularly. The goal is not to eliminate mistakes. The goal is to make sure mistakes do not destroy you. Intrinsic value is the true economic worth of a business based on its ability to generate cash over time. It is not the current market price. It is not yesterday's price. It is not analyst targets. It is an estimate of how much money a business will produce for owners throughout its life, adjusted to today's value. Markets are constantly pricing businesses based on emotion, news, expectations, fear, and excitement. Intrinsic value is based on fundamentals: revenue, profit margins, cash flow, growth potential, competitive advantage, and capital efficiency. Price is what you pay. Value is what you get. Imagine a small bakery that earns consistent profit every year. If that bakery produces predictable cash flow, you can estimate how much it might earn over the next decade. If you add those future earnings together and adjust for time and risk, you get an estimate of intrinsic value. Public companies are simply larger, more complex versions of this same concept. Intrinsic value is not a precise number. It is a range. Different investors may calculate slightly different values based on assumptions about growth, competition, or economic conditions. That is why margin of safety exists. Margin of safety means buying a business for significantly less than your estimate of its intrinsic value. This protects you from three major risks: calculation errors, unexpected business problems, and market volatility. If you believe a company is worth $100 per share, buying it at $95 gives you almost no protection. But buying it at $60 gives you a large buffer. That buffer absorbs mistakes and uncertainty. If your valuation is slightly wrong, or if business conditions worsen temporarily, you still have protection. Margin of safety is the shock absorber of investing. Markets are unpredictable. Economies cycle. Consumer behavior changes. Regulation shifts. Competition evolves. Margin of safety acknowledges uncertainty instead of ignoring it. Many investors focus only on upside potential. Intelligent investors focus first on downside protection. Protecting capital allows compounding to continue. Losing large amounts of capital destroys compounding. For example, losing 50% of your capital requires a 100% gain just to recover. Avoiding large losses is mathematically powerful. Margin of safety also provides emotional stability. When you buy at deep discounts, short-term price drops become less stressful. You already built protection into your decision. Emotional investors often panic because they bought with no protection. Margin of safety also forces discipline. It prevents chasing popular stocks at inflated prices. Many investors know a company is great, but still overpay. A great business bought at a terrible price can produce poor investment results. Intrinsic value also shifts your focus toward business analysis instead of market prediction. You're no longer asking, will this stock go up next month? You're asking, is this business undervalued relative to its long-term earning power? This shift moves you from speculation toward investing. Intrinsic value analysis often focuses heavily on cash flow. Accounting profits can be influenced by accounting rules. Cash flow represents actual money generated. Businesses with strong, consistent free cash flow often support higher intrinsic value stability. Growth quality also matters. High growth is valuable only if it produces real profits over time. Some companies grow revenue rapidly but lose money continuously. Growth without profit can create valuation risk. Intrinsic value also requires understanding industry structure. Some industries allow stable profit margins. Others constantly face price competition. Industry structure affects long-term intrinsic value stability. Another key factor is return on invested capital. Businesses that generate high returns on capital can grow faster internally without constant external funding. This often increases intrinsic value growth potential. Intrinsic value also includes management capital allocation skill. Great management can increase intrinsic value through smart reinvestment, acquisitions, and cost control. Poor management can destroy value even if the business model is strong. Margin of safety also creates opportunity during market fear. When markets panic, prices often fall faster than intrinsic value. This creates discount buying opportunities for disciplined investors. This is psychologically difficult. Buying during fear requires emotional control. But historically, the best long-term returns often come from buying when others are selling irrationally. Margin of safety also requires patience. Sometimes markets stay irrational for long periods. Undervalued businesses may remain undervalued temporarily. Investors must allow value recognition to happen over time. Intrinsic value investing also reduces reliance on market timing. Instead of predicting when markets will rise or fall, you focus on buying undervalued businesses whenever they appear. This reduces complexity and emotional stress. Another important truth: intrinsic value investing requires humility. Your valuation will never be perfect. New information appears constantly. Assumptions must be updated. Intelligent investors adjust valuations when facts change. Intrinsic value and margin of safety together form the mathematical foundation of intelligent investing. Intrinsic value tells you what something might be worth. Margin of safety tells you how much protection you need when buying it. And when you combine rational valuation with protective buying discipline, you move from hoping markets reward you to preparing for whatever markets do next. Intrinsic value becomes more powerful when you understand how fragile most market pricing can be in the short term. Markets are efficient over long periods, but in the short term, they are influenced heavily by human psychology. Fear, greed, headlines, interest rate expectations, and global events can all push prices far above or far below intrinsic value temporarily. This is why intrinsic value investing requires patience and emotional discipline. The market does not always correct mispricing immediately. Sometimes undervalued businesses remain undervalued for months or even years. But over long time horizons, price tends to follow value. Intrinsic value estimation usually begins with understanding how a company makes money. You must understand revenue sources, cost structure, customer behavior, and competitive position. Without this, intrinsic value becomes guesswork instead of analysis. Then comes future projection. Investors estimate how much cash a business may generate in future years. This requires assumptions about growth rate, competition, pricing power, and industry demand. These assumptions will never be perfect, which is why margin of safety is essential. Future cash flows are then adjusted to present value. Money received in the future is worth less than money received today because of inflation and opportunity cost. Discounting future cash flows helps estimate what future earnings are worth today. While this may sound mathematical, the most important part is judgment. Numbers come from assumptions. Assumptions come from understanding. And understanding comes from studying business reality, not market noise. Margin of safety exists because reality is unpredictable. Even if your analysis is strong, unexpected events can occur. New competitors may emerge. Technology may disrupt industries. Economic recessions may reduce demand. Regulation may change profit models. Buying with margin of safety acknowledges that uncertainty is permanent. Margin of safety also protects against optimism bias. Investors naturally want to believe their analysis is correct. Buying at large discounts forces humility. It forces investors to demand extra protection before committing capital. Another powerful effect of margin of safety is emotional comfort during volatility. If you buy at fair value and the price drops, fear increases quickly. If you buy far below intrinsic value, price drops feel less threatening because you expected volatility. This psychological advantage is extremely important. Many investors lose money not because they choose bad businesses, but because they panic during volatility. Margin of safety reduces panic risk. Intrinsic value investing also reduces dependency on forecasts. Predicting exact future events is extremely difficult. Instead, intrinsic value focuses on business durability. Durable businesses often survive unexpected shocks better than fragile businesses. For example, businesses selling essential goods or services often maintain demand even during recessions. Businesses dependent on luxury spending or short-term trends often experience larger demand swings. Understanding demand stability helps refine intrinsic value estimates. Another key component is balance sheet strength. Companies with strong cash reserves and manageable debt can survive economic downturns longer. Survival allows long-term value to recover. Companies with weak balance sheets may be forced into bad decisions during crises. Intrinsic value also evolves over time. As businesses grow earnings, intrinsic value increases. As businesses decline, intrinsic value decreases. Intelligent investors continuously update intrinsic value estimates based on new data. Margin of safety also helps investors avoid speculative bubbles. During market bubbles, prices often disconnect completely from intrinsic value. Investors buying purely on momentum expose themselves to massive downside risk when reality returns. Intrinsic value investing requires independent thinking. When markets become euphoric, intrinsic value discipline may prevent you from participating in popular investments. This can feel uncomfortable in the short term, but often protects capital long term. Margin of safety also allows investors to survive mistakes. No investor has perfect information. Some investments will underperform. Margin of safety ensures mistakes are survivable rather than catastrophic. Another powerful benefit is improved portfolio stability. When most investments are purchased with margin of safety, portfolio drawdowns often become less severe during market corrections. Reduced drawdowns improve long-term compounding. Intrinsic value investing also encourages long-term learning. Studying businesses deeply teaches you about industries, consumer behavior, technology trends, and economic cycles. Investing becomes continuous education. Another important insight: intrinsic value investing does not require finding perfect businesses. It requires finding businesses that are good enough at prices that are cheap enough. Price often matters more than perfection. Sometimes average businesses bought extremely cheaply can outperform great businesses bought at extreme valuations. Price paid determines future return potential significantly. Intrinsic value also forces investors to focus on real drivers of value creation: earnings growth, return on capital, and reinvestment opportunity. These drivers ultimately determine long-term shareholder return. Margin of safety also creates decision discipline. It forces investors to say no frequently. Most investment opportunities should be rejected. Only a few truly offer strong margin of safety at any time. This selectivity improves average investment quality. Intrinsic value and margin of safety together create a powerful decision framework. They transform investing from emotional reaction to rational evaluation. Instead of asking whether the market will reward you quickly, you ask whether the business is fundamentally worth more than the price offered. And when you consistently buy value at a discount, time becomes your ally rather than your enemy. Because markets may delay recognizing value, but they rarely ignore forever. Margin of safety also changes how you think about uncertainty at a deeper level. Most people try to eliminate uncertainty before making decisions. Intelligent investors accept uncertainty as permanent and build protection around it. This mindset is extremely powerful because it aligns with reality. Markets will never be fully predictable. Economies will never move in straight lines. Businesses will never operate in perfectly stable environments. Instead of demanding certainty, intelligent investors demand protection. This protection can come from price discounts, strong balance sheets, durable competitive advantages, and predictable demand patterns. The stronger these protections, the less damage uncertainty can cause. Margin of safety also improves long-term survival probability. Investing is not a short race. It is a long endurance process. Investors who avoid catastrophic losses can stay in the game long enough for compounding to work. Investors who experience large permanent losses often cannot recover. Survival is the first rule of compounding. Another important effect of margin of safety is decision clarity during market stress. When markets crash, prices fall quickly. Emotional investors feel forced to react. Investors with margin of safety have more decision flexibility. They can hold calmly, or even buy more if intrinsic value remains intact. This emotional stability becomes a competitive advantage. Intrinsic value and margin of safety also improve portfolio construction logic. Instead of spreading money randomly across many ideas, investors can allocate more capital to opportunities, offering the largest gap between price and value. Larger discount gaps often create better risk-adjusted return potential. However, margin of safety is not only about buying cheap stocks. Sometimes businesses appear cheap because they are declining structurally. Intelligent investors must distinguish between temporary price decline and permanent business deterioration. This requires continuous learning and honest evaluation. If business fundamentals weaken permanently, intrinsic value declines. Margin of safety must be recalculated. Another powerful benefit of margin of safety is protection against narrative risk. Markets often create strong stories around companies. These stories can be positive or negative. Narrative-driven pricing often disconnects from reality. Margin of safety protects investors from narrative extremes. Intrinsic value analysis also requires studying economic cycles. Some businesses perform strongly during economic expansion, but weaken during recessions. Others remain stable regardless of economic conditions. Understanding cycle sensitivity improves intrinsic value estimation. Margin of safety also protects against interest rate changes. Rising interest rates often reduce stock valuations broadly. Investors buying without margin of safety may experience large price declines simply due to macroeconomic changes, even if business performance remains stable. Intrinsic value investing also improves tax efficiency indirectly. Long-term holding reduces transaction frequency. Lower turnover often reduces taxable events. Compounding works more efficiently when taxes are minimized. Another key insight: intrinsic value investing rewards patience disproportionately. Markets often overreact to short-term news. Investors willing to wait for normalization often benefit. This requires emotional discipline, not just analytical skill. Margin of safety also creates psychological freedom. When you know you bought well below estimated value, you worry less about daily price movement. Reduced emotional stress improves decision-making quality. Intrinsic value also helps investors identify when to sell. If price rises significantly above intrinsic value, future return potential decreases. Selling overvalued assets and reallocating to undervalued ones improves long-term portfolio efficiency. Margin of safety is dynamic, not static. As price rises or business fundamentals change, margin of safety changes. Intelligent investors continuously monitor valuation gaps. Another benefit is protection against forecast errors. Growth projections often turn out wrong. Margin of safety absorbs projection errors. If growth is slightly lower than expected, you still maintain acceptable return potential. Intrinsic value investing also aligns with probabilistic thinking. Instead of predicting exact outcomes, investors estimate ranges of possible outcomes. Margin of safety increases probability of acceptable results, even if best-case scenarios do not occur. Another powerful insight: intrinsic value investing reduces competition. Most market participants focus on short-term price prediction. Fewer investors focus deeply on business valuation. Less competition often creates more opportunity. Margin of safety also reduces regret risk. Investors who overpay often feel regret quickly if prices drop. Investors who buy with margin of safety often feel more confident during volatility. Intrinsic value investing also strengthens intellectual independence. When you understand valuation deeply, you rely less on analyst opinions, media commentary, or social sentiment. Independent thinking improves long-term performance. Another important truth is that intrinsic value investing is not about perfection. It is about process quality. Good process leads to good long-term outcomes, even if individual investments fail. Margin of safety also supports portfolio longevity across market cycles. Markets will experience bull markets, bear markets, inflation periods, deflation periods, and structural economic changes. Margin of safety increases survival across these cycles. Intrinsic value investing ultimately transforms your relationship with markets. Instead of feeling controlled by market movement, you begin using market movement. Volatility becomes opportunity rather than threat. You stop asking, "What will the market do next?" You start asking, "Is this business worth significantly more than today's price?" And when you consistently demand value protection before committing capital, investing becomes less about hope and more about preparation. Because intelligent investing is not about predicting perfect outcomes. It is about making decisions that work even when outcomes are imperfect. Chapter 3, Mr. Market: Mastering Emotional Volatility. Imagine you own a small share of a private business with a strange partner. Every single day, this partner comes to your door and offers to buy your share or sell you more shares at a new price. Some days he is extremely optimistic. He believes the business is worth far more than it actually is. Other days he is deeply depressed. He believes the business is nearly worthless. But here's the key detail: you are never required to accept his offer. This is the idea behind Mr. Market. Mr. Market represents the emotional nature of financial markets. Markets are not perfectly rational machines. They are collections of human decisions. Fear, excitement, panic, greed, uncertainty, and overconfidence, all expressed through price movement. Mr. Market shows up every day with a new price. But intelligent investors understand something powerful. Price is an offer, not an instruction. You can accept the offer. You can ignore the offer. You can exploit the offer. Most investors treat market prices as signals telling them what to do. When prices rise, they feel they must buy quickly before missing out. When prices fall, they feel they must sell quickly before losing more. But Mr. Market is emotional. Emotional partners are unreliable decision guides. Sometimes Mr. Market is euphoric. During euphoric periods, prices often rise far above intrinsic value. Investors become convinced prices will keep rising forever. Stories become more important than fundamentals. Risk gets ignored. Other times, Mr. Market is depressed. During depressed periods, prices often fall far below intrinsic value. Investors become convinced businesses will never recover. Fear replaces rational analysis. Intelligent investors treat Mr. Market as a service provider, not an advisor. If Mr. Market offers to buy your share at an extremely high price, you may choose to sell. If Mr. Market offers to sell you shares at extremely low prices, you may choose to buy. But you never let Mr. Market's mood determine your strategy. Understanding Mr. Market also helps you avoid panic selling. Panic selling usually happens when investors mistake price decline for value destruction. But price decline often reflects emotion, not business reality. If business fundamentals remain strong, lower prices may represent opportunity. If business fundamentals weaken permanently, then price decline may be justified. Intelligent investors separate emotional price movement from real business deterioration. Mr. Market also explains why bubbles form. During bubble periods, group psychology creates feedback loops. Rising prices attract more buyers. More buyers push prices higher. Higher prices create more excitement. Eventually, price disconnects completely from intrinsic value. When reality returns, bubbles collapse quickly. Mr. Market also explains why crashes happen. During crashes, fear spreads quickly. Selling creates more selling. Prices drop faster than business fundamentals decline. This creates undervaluation opportunities for rational investors. But exploiting Mr. Market requires emotional discipline. It is psychologically difficult to buy when everyone else is selling. It is difficult to sell when everyone else is buying. This is why intelligent investing is not only analytical, it is psychological. Mr. Market also teaches patience. You do not need to react every day. Mr. Market will return tomorrow with another price. You only act when price creates advantage relative to value. This removes pressure to constantly trade. Mr. Market also helps you understand volatility differently. Volatility is not risk by itself. Volatility is price movement. Risk is permanent loss of capital. Sometimes volatility creates opportunity. Sometimes it creates warning signals. But volatility alone is not danger. Another powerful insight from Mr. Market is emotional independence. When you rely on market sentiment for decision-making, you lose independence. When you rely on business fundamentals and intrinsic value, you maintain control. Mr. Market also teaches humility. Markets will test your conviction. Sometimes prices will move against you even when your analysis is correct. Intelligent investors prepare emotionally for this possibility. Mr. Market also creates constant learning opportunities. By observing market reactions to news, economic events, and business announcements, you learn how crowd psychology behaves. This improves pattern recognition over time. Another key truth is that Mr. Market is most dangerous when he agrees with you emotionally. When market optimism matches your optimism, risk often increases. When market pessimism matches your fear, opportunity often increases. Mr. Market also explains why market timing is extremely difficult. Predicting Mr. Market's mood is nearly impossible consistently. Instead of predicting mood, intelligent investors focus on valuation relative to intrinsic value. Mr. Market also rewards emotional stability. Investors who remain calm during volatility often outperform those who react emotionally. Emotional control creates decision advantage. Mr. Market also creates opportunities through overreaction. Markets often overreact to short-term news. Overreaction creates mispricing. Mispricing creates opportunity for disciplined investors. Understanding Mr. Market transforms how you experience markets. Instead of feeling controlled by price movement, you begin seeing price movement as negotiation opportunity. You stop fearing volatility. You start evaluating volatility. And when you stop letting emotional price swings control your decisions, you move closer to one of the deepest truths of intelligent investing. Markets will always be emotional, but you don't have to be. Mr. Market also teaches one of the most important psychological lessons in investing. You are not required to participate in every opportunity he presents. Many investors feel pressure to always be doing something, buying, selling, adjusting, reacting. But intelligent investors understand that inactivity is often a rational decision. You only act when price and value diverge significantly. Mr. Market's constant activity can create the illusion that action equals intelligence. In reality, intelligent investing often looks boring. Long periods of waiting, occasional decisive action, then more waiting. This rhythm feels uncomfortable to people trained to associate activity with productivity. But in markets, excessive activity often destroys returns. Mr. Market also highlights the importance of emotional separation. When prices rise quickly, excitement spreads. When prices fall quickly, fear spreads. Intelligent investors train themselves to observe these emotions without adopting them. You observe market emotion the same way a scientist observes an experiment. You record it, you analyze it, but you do not become part of it. Mr. Market also shows how narrative drives price. Markets often create stories to explain price movement. During rising markets, narratives focus on innovation, growth, and opportunity. During falling markets, narratives focus on risk, uncertainty, and collapse. But narratives follow price more often than they predict price. Intelligent investors focus on business fundamentals first and narrative second. Mr. Market also teaches asymmetry awareness. Extreme optimism often creates downside risk. Extreme pessimism often creates upside potential. Intelligent investors pay attention when market sentiment becomes extreme. This does not mean acting blindly against the crowd. It means analyzing whether sentiment extremes create valuation distortions. Mr. Market also explains why investors struggle with regret. When prices rise after selling, investors feel regret. When prices fall after buying, investors feel regret. Mr. Market constantly creates emotional traps. Intelligent investors focus on process quality, not outcome perfection. Even perfect decisions can produce bad short-term outcomes. Even poor decisions can produce good short-term outcomes. Over time, good process matters more than individual outcomes. Mr. Market also demonstrates how short-term price movement rarely reflects long-term business change. Businesses change slowly. Market prices change instantly. This mismatch creates opportunity for investors willing to focus on fundamentals. Mr. Market also teaches information filtering. Financial media often amplifies Mr. Market's emotional behavior. News headlines focus on urgency. Urgency creates emotional reaction. Intelligent investors filter news through valuation and business analysis. Mr. Market also reinforces the importance of time horizon advantage. Most market participants operate on short time horizons. Intelligent investors often operate on longer horizons. Longer horizons reduce competition and increase opportunity. Mr. Market also teaches probability thinking. Markets do not produce certain outcomes. They produce probability distributions. Intelligent investors focus on decisions that produce acceptable results across many possible futures. Mr. Market also shows the danger of price anchoring. Investors often anchor to past prices. They think a stock that fell must recover to its previous price. But past price has no inherent meaning. Only intrinsic value matters. Mr. Market also creates momentum traps. Rising prices attract attention. Attention attracts buying. Buying pushes price higher. Eventually, price disconnects from value. Intelligent investors avoid buying purely based on recent price movement. Mr. Market also teaches emotional timing risk. Buying when you feel most confident often means buying near price peaks. Selling when you feel most afraid often means selling near price bottoms. Emotional timing often produces opposite results of desired outcomes. Mr. Market also highlights liquidity advantage. Public markets allow investors to act when mispricing appears, but liquidity also increases emotional reaction frequency. Intelligent investors use liquidity selectively. Mr. Market also reinforces that volatility is normal, not exceptional. Price movement is constant. Emotional reaction is optional. Intelligent investors normalize volatility mentally. Mr. Market also shows why diversification supports emotional stability. When portfolios are diversified, individual price swings create less emotional stress. Lower stress improves rational decision-making. Mr. Market also demonstrates that long-term success often comes from avoiding big mistakes rather than finding perfect opportunities. Emotional overreaction creates most big mistakes. Mr. Market also reveals that markets reward emotional discipline more than analytical brilliance. Many investors have strong analytical ability. Fewer have strong emotional control. Emotional control often determines real-world performance. Mr. Market also reminds investors that market participation is voluntary daily. You are not required to react to price movement. You are not required to predict market direction. You are only required to make rational decisions when true opportunity appears. When you fully internalize Mr. Market, you stop seeing markets as judges evaluating you daily. You start seeing markets as partners offering optional transactions. And when you truly see price as an offer instead of an order, emotional pressure decreases dramatically. You stop asking, "What is the market telling me to do?" You start asking, "Does this offer benefit me based on business value?" And when you consistently treat market emotion as opportunity instead of instruction, you move closer to true investing independence. Because markets will always fluctuate, but intelligent investors learn to fluctuate less than the markets around them. Mr. Market also reveals something deeper about human nature. People often feel safer moving with the crowd, even when the crowd is wrong. In markets, crowd behavior amplifies emotional extremes. When prices rise, social validation increases. When prices fall, social fear increases. Intelligent investors must learn to separate social comfort from financial logic. Crowds provide emotional safety, but emotional safety often appears at financial danger points. When everyone feels confident, prices often already reflect extreme optimism. When everyone feels fearful, prices often already reflect extreme pessimism. Intelligent investors learn to become emotionally comfortable with being temporarily uncomfortable. Mr. Market also teaches delayed gratification. When markets become excited about new trends, intelligent investors often must resist participating until valuations become reasonable. This can feel like missing out, but avoiding overpayment protects long-term capital. Mr. Market also demonstrates how short-term performance pressure damages decision quality. Many investors compare performance monthly or quarterly. This forces short-term thinking. Intelligent investors focus on multi-year outcomes. Short-term measurement encourages short-term behavior. Long-term measurement encourages long-term thinking. Mr. Market also reveals how leverage increases emotional risk. Borrowed money amplifies both gains and losses. During market volatility, leverage investors often face forced selling. Forced selling destroys long-term compounding. Intelligent investors use leverage carefully, if at all. Mr. Market also teaches how liquidity can become a trap. Because you can sell instantly, you may feel pressure to act instantly. But instant action is rarely required for intelligent decision-making. Liquidity is a tool, not a command. Mr. Market also shows how price volatility tests conviction. If you truly understand why you own a business, volatility becomes easier to tolerate. If you do not understand why you own it, volatility becomes unbearable. Understanding creates emotional stability. Mr. Market also demonstrates how expectation drives price. Prices often move based on expectation changes, not just business performance changes. A company can report strong results but still see price drop if expectations were even higher. Intelligent investors focus on long-term value creation, not short-term expectation reaction. Mr. Market also teaches patience in capital deployment. Sometimes markets become fully valued or overvalued broadly. During these periods, intelligent investors may hold more cash. This feels uncomfortable but protects future opportunity potential. Cash is not failure. Cash is optionality. Mr. Market also reinforces that emotional narratives change quickly. Today's unstoppable growth story can become tomorrow's structural risk story. Intelligent investors focus on business fundamentals rather than narrative cycles. Mr. Market also shows why market predictions are unreliable. Economic forecasts, market forecasts, and political forecasts constantly change. Intelligent investors build strategies that work across multiple possible futures instead of betting on one specific outcome. Mr. Market also teaches the importance of position sizing. Even strong investment ideas carry uncertainty. Intelligent investors size positions based on conviction, risk tolerance, and margin of safety. Mr. Market also reveals how volatility clusters. Periods of low volatility often lead to periods of high volatility. Investors who assume calm markets are permanent often become unprepared for sudden changes. Mr. Market also demonstrates how investor memory is short. Each market cycle feels unique emotionally, even though patterns repeat historically. Intelligent investors study financial history to recognize recurring psychological cycles. Mr. Market also highlights the difference between noise and signal. Daily price movement is mostly noise. Long-term earnings growth is signal. Intelligent investors focus on signal. Mr. Market also shows why portfolio turnover should be low. Constant reaction to price movement increases transaction costs, taxes, and emotional mistakes. Intelligent investors trade only when valuation or business fundamentals change significantly. Mr. Market also demonstrates that time horizon is one of the largest competitive advantages available to investors. Most participants focus on short-term outcomes. Investors willing to focus on long-term outcomes often face less competition and more opportunity. Mr. Market also teaches humility repeatedly. Even rational investors experience temporary losses. Markets can stay irrational longer than expected. Emotional preparation for this reality is essential. Mr. Market also reveals that intelligent investing requires self-awareness. You must understand your emotional reactions to volatility. If volatility causes panic, you must design strategies that reduce emotional pressure. Mr. Market also shows why investing is as much psychological as analytical. Analytical skill identifies opportunity. Psychological discipline allows you to act on it correctly. Mr. Market ultimately represents a daily test of rationality. Every price movement asks a question. Will you react emotionally or will you think rationally? Markets will always contain fear and greed. These forces will never disappear. But intelligent investors learn to observe them without joining them. And once you truly understand Mr. Market, price movement stops feeling like judgment and starts feeling like opportunity. Because in the end, markets do not reward the most active investors. They reward the most rational ones over time. Chapter 4, Diversification, Survival Before Success. One of the biggest myths in investing is that success comes from finding one perfect investment. In reality, intelligent investing is not built on perfection. It is built on survival. And diversification is one of the strongest tools for survival. Diversification means spreading your investments across multiple assets so that one mistake does not destroy your financial future. Even the best investors in history make mistakes. Businesses fail. Industries change. Technology disrupts markets. Economic shocks appear without warning. Diversification accepts a simple truth. You will be wrong sometimes. The goal is not to eliminate mistakes. The goal is to make sure mistakes are survivable. Imagine placing all your capital into one company. If that company fails, your financial future collapses. If you spread your investments across multiple strong businesses, one failure becomes manageable instead of catastrophic. Diversification is not about maximizing return. It is about protecting compounding. Compounding only works if capital survives long enough. Large losses interrupt compounding dramatically. Avoiding catastrophic loss is often more important than chasing maximum short-term return. Diversification also protects against unknown risks. Some risks are visible. Others are invisible until they happen. Regulatory changes, political shifts, technological disruption, or supply chain collapse can affect individual companies unexpectedly. Diversification spreads exposure across multiple risk sources. Diversification also reduces emotional stress. When one investment drops significantly, diversified investors experience less portfolio impact. Lower emotional stress improves decision-making. Emotional investors often make poor decisions under pressure. Diversification also improves long-term consistency. Instead of relying on one idea being perfect, diversification allows multiple ideas to contribute to growth. Some investments outperform, some underperform. The portfolio grows steadily overall. Diversification also protects against overconfidence. Investors who believe they found perfect investments often ignore hidden risks. Diversification enforces humility. Diversification can occur across multiple dimensions. Sector diversification spreads investments across industries like technology, healthcare, finance, consumer goods, and energy. Industry cycles often differ. When one sector weakens, another may strengthen. Geographic diversification spreads investments across different countries or regions. Different economies grow at different speeds. Political and currency risks vary across regions. Asset class diversification spreads investments across stocks, bonds, real estate commodities, or alternative assets. Different asset classes respond differently to economic changes like inflation, recession, or interest rate shifts. Diversification also helps investors avoid timing risk. Even strong businesses may be purchased at high valuations accidentally. If portfolios are diversified, valuation timing errors have smaller overall impact. Diversification also reduces the danger of unpredictable events. Corporate scandals, legal issues, product failures, or management mistakes can affect individual companies suddenly. Diversification protects portfolios from single-event collapse. However, diversification must be intelligent. Over-diversification can dilute returns. If you own too many investments, strong performers cannot significantly influence overall results. Intelligent diversification balances risk protection with meaningful exposure to high-quality opportunities. Diversification also requires understanding correlation. Some investments appear diversified, but actually move together. For example, companies in similar industries may respond similarly to economic changes. True diversification requires exposure to assets influenced by different factors. Diversification also improves long-term holding discipline. When portfolios are diversified, investors are less likely to panic sell during volatility. Emotional stability improves long-term return potential. Diversification also helps protect against forecasting errors. Investors cannot perfectly predict future winners. Diversification allows multiple potential winners to exist inside the portfolio. Diversification also improves adaptability. As economic environments change, different sectors or asset classes perform better. Diversified portfolios adapt naturally to changing conditions. Diversification also supports psychological comfort. Investing should allow you to sleep at night. Concentrated portfolios often create stress. Stress leads to emotional decision mistakes. Diversification is not about eliminating risk. It is about managing risk intelligently. Diversification also reflects humility toward market complexity. Markets are influenced by countless variables. No investor can fully understand every factor. Diversification protects against unknown unknowns. Another key insight: diversification does not protect against market-wide crashes, but it often reduces damage compared to concentrated portfolios and improves recovery speed. Diversification also creates optionality. When some assets perform strongly, investors can rebalance into undervalued opportunities. Rebalancing forces disciplined buying low and selling high automatically. Diversification also aligns with long-term wealth preservation strategies used by institutions and family wealth managers. Large capital pools focus heavily on risk control because protecting capital becomes more important than maximizing short-term return. Diversification also reduces regret risk. When portfolios are diversified, investors are less likely to experience extreme regret from single investment failure. Intelligent investors understand diversification is not weakness. It is strategic strength, because long-term investing is not about proving you are right. It is about making sure you can continue investing. And survival is what allows compounding to do its work. Because in the end, wealth is not built by one perfect decision. It is built by many good decisions protected from catastrophic mistakes. Diversification also changes how you think about uncertainty in a practical, real-world way. Instead of trying to predict which single company, sector, or country will perform best, diversification allows you to participate in multiple potential growth paths at the same time. This reduces dependence on perfect prediction. Prediction is fragile. Systems are durable. When you build a diversified portfolio, you are building a system designed to perform across different environments. Some assets may perform well during economic expansion. Others may perform well during recession. Some perform well during inflation. Others perform well during deflation. Diversification acknowledges that the future will not follow a single predictable path. Diversification also protects against narrative concentration. Every decade has dominant investment narratives. Technology revolutions, real estate booms, commodity cycles, or emerging market growth stories. Sometimes these narratives are partially correct. But when too much capital concentrates into one story, risk increases. Diversification prevents total dependence on one narrative being correct. Diversification also helps manage behavioral risk. Investors often become emotionally attached to individual investments. Emotional attachment reduces objectivity. Diversification forces investors to think in portfolio terms instead of individual story terms. Portfolio thinking improves rational decision-making. Diversification also improves recovery potential. When markets decline, different assets often recover at different speeds. Diversified portfolios often stabilize faster than concentrated portfolios. Faster recovery improves long-term compounding. Diversification also reduces income volatility. Some investments produce stable income even when growth investments become volatile. Stable income streams improve psychological comfort and financial stability. Diversification also creates rebalancing opportunity. When some investments outperform strongly, they become larger portions of portfolio. Rebalancing allows investors to trim high performers and add to underperforming assets with strong fundamentals. This enforces disciplined buy low, sell high behavior without emotional decision-making. Diversification also improves long-term return stability. Highly concentrated portfolios often produce extreme highs and extreme lows. Diversified portfolios often produce smoother growth patterns. Smooth growth improves investor behavior consistency. Diversification also protects against technological disruption risk. New technologies can disrupt entire industries unexpectedly. Owning exposure across multiple industries reduces risk of permanent capital loss from single industry disruption. Diversification also protects against regulatory risk. Government policy changes can dramatically affect specific industries. Diversification reduces policy concentration risk. Diversification also helps protect against currency and geopolitical risk. Global diversification spreads exposure across different economic systems, reducing dependence on any single country's stability. Diversification also improves capital allocation flexibility. When portfolios contain multiple asset types, investors can shift allocation gradually based on valuation differences and economic conditions. Diversification also reduces reliance on perfect entry timing. Even strong businesses purchased at temporary overvaluation can underperform short-term. Diversified portfolios reduce the damage from timing errors. Diversification also supports risk-adjusted return optimization. Intelligent investing is not only about maximizing return, it is about maximizing return relative to risk taken. Diversification improves risk-adjusted outcomes over long periods. Diversification also improves longevity of investment strategy. Strategies that rely on single-sector dominance often fail when sector cycles change. Diversified strategies adapt more naturally to economic evolution. Diversification also reinforces probabilistic thinking. Instead of expecting one investment to succeed perfectly, diversified portfolios allow multiple potential success paths. Diversification also reduces catastrophic drawdown risk. Large drawdowns damage compounding and investor confidence. Diversification reduces the probability of catastrophic drawdowns. Diversification also improves investor emotional endurance. Investing is psychological endurance as much as financial analysis. Diversification reduces emotional strain, making long-term discipline easier to maintain. Diversification also helps maintain long-term participation. Investors who experience extreme losses often exit markets permanently. Diversification reduces exit risk by controlling loss severity. Diversification also aligns with how professional capital managers operate. Pension funds, endowments, and sovereign wealth funds rely heavily on diversification because their priority is long-term capital preservation and steady growth. Diversification also reinforces humility toward market complexity. Markets are influenced by countless unpredictable variables: technology innovation, political events, natural disasters, demographic shifts, and behavioral psychology. Diversification acknowledges this complexity honestly. Another important truth: diversification is not about owning everything. It is about owning enough independent drivers of return that no single failure can destroy long-term progress. Diversification also helps investors avoid identity-based investing mistakes. Some investors become emotionally identified with specific companies or sectors. Diversification forces broader perspective. Diversification also supports long-term learning. Exposure to multiple industries improves business understanding and economic pattern recognition. Ultimately, diversification transforms investing from fragile prediction into resilient system design. Because long-term wealth is rarely built by finding one perfect investment. It is built by constructing systems that survive mistakes, survive volatility, and continue compounding through unpredictable environments. And when you focus on survival first, success often follows naturally. Because in investing, staying the game is often more important than winning every round. Chapter 5: Patience and Emotional Discipline, the Wealth Multiplier. If diversification protects your capital, patience and emotional discipline protect your decision-making. And in long-term investing, decision quality often matters more than intelligence, speed, or access to information. Markets reward time, not activity. Most investors believe wealth comes from constant action, buying quickly, selling quickly, reacting quickly. But markets often reward the opposite. The most powerful force in investing is compounding. And compounding requires one thing above everything else: time. Compounding is quiet at first. It feels slow. It feels boring. But over long periods, compounding becomes explosive. Small, consistent growth multiplied over years creates results that short bursts of activity rarely match. Patience allows compounding to work. Emotional discipline allows patience to survive volatility. Without emotional discipline, investors interrupt compounding. They sell during fear. They chase during excitement. They constantly reset their compounding timeline by reacting to market noise. Emotional investors often follow predictable behavior patterns. They buy when prices feel safe, usually after prices have already risen significantly. They sell when prices feel dangerous, usually after prices have already fallen significantly. This behavior destroys long-term returns. Rational investors behave differently. They buy when value appears, even if sentiment is negative. They hold through volatility if business fundamentals remain strong. They sell when valuation becomes irrationally high, not when emotion peaks. Patience also protects investors from overtrading. Every trade introduces cost, transaction fees, taxes, and emotional risk. Over long periods, these costs compound negatively. Low turnover often improves long-term returns. Patience also improves analytical accuracy. Businesses reveal their true quality over time. Short-term results can be misleading. Temporary success can hide structural weakness. Temporary problems can hide long-term strength. Time reveals business reality. Emotional discipline also protects against news-driven decision mistakes. Financial news is designed to create urgency. Urgency triggers emotional reaction. Emotional reaction reduces decision quality. Intelligent investors filter news through long-term business impact analysis. Patience also supports valuation discipline. Many investors abandon valuation discipline during strong bull markets. Fear of missing out pushes them into overpaying. Patience protects investors from participating in unsustainable price increases. Emotional discipline also protects during market crashes. Crashes create intense fear. Fear creates urgency. Urgency creates poor decisions. Emotional discipline allows investors to analyze whether price decline reflects business reality or market panic. Patience also supports capital allocation timing. Sometimes the best investment decision is waiting for better valuation, waiting for better opportunity, waiting for clearer information. Cash can be a strategic asset during overvalued market periods. Emotional discipline also improves long-term psychological stability. Constant emotional reaction creates stress. Structured decision-making reduces stress. Patience also improves portfolio turnover efficiency. Long holding periods allow capital gains to compound tax efficiently in many jurisdictions. Frequent trading often increases tax drag. Emotional discipline also helps investors avoid comparison traps. Markets constantly produce stories of fast gains. Comparing your long-term strategy to short-term speculation creates emotional pressure. Emotional pressure leads to poor decisions. Patience requires confidence in process, not prediction. Patience also improves pattern recognition. Investors who stay in markets long enough see multiple cycles: booms, crashes, recoveries, bubbles, and resets. Experience improves decision quality. Emotional discipline also protects against regret-driven trading. Many investors make decisions to avoid regret rather than maximize return. Regret avoidance often produces poor long-term outcomes. Patience also aligns with business growth reality. Real businesses grow through product development, customer acquisition, operational improvement, and market expansion. These processes take time. Emotional discipline also protects investors from narrative cycles. Market narratives change constantly. Emotional investors follow narrative trends. Rational investors follow valuation and fundamentals. Patience also reduces burnout. Constant market monitoring creates emotional fatigue. Long-term investors monitor less frequently and think more strategically. Emotional discipline also requires self-awareness. Investors must recognize their emotional triggers: fear of loss, fear of missing out, overconfidence after gains. Recognizing emotional patterns improves decision control. Patience also requires expectation management. Markets will not produce smooth returns. There will be periods of stagnation and decline. Patience prepares investors emotionally for these periods. Another important truth: patience is difficult because it feels like inaction. But in investing, inaction is often active discipline. Emotional discipline is difficult because it requires resisting human instinct. Humans evolved to react quickly to danger and opportunity. Markets reward controlled reaction. Patience also allows intrinsic value recognition to occur. Markets often misprice businesses temporarily. Over time, business performance often drives price correction. Patience and emotional discipline together create one of the strongest advantages in investing. Information advantage disappears quickly. Technology advantage disappears quickly. Emotional discipline advantage is extremely rare and extremely valuable because most investors cannot stay rational when money and uncertainty combine. And when you combine rational analysis with emotional control and long-term patience, you unlock the true multiplier effect of intelligent investing. Because wealth is not built by reacting faster than others. It is built by staying disciplined longer than others. Patience and emotional discipline become even more powerful when you understand how time interacts with uncertainty. In the short term, markets are dominated by randomness. News events, macroeconomic data, investor sentiment, and unexpected global developments constantly move prices. In the long term, however, business fundamentals usually dominate. This is why short-term investing often feels chaotic, while long-term investing feels more predictable. Patience allows randomness to smooth out. Emotional discipline allows you to stay invested long enough for fundamentals to matter. Another critical insight is that most investment mistakes happen during emotional extremes. During market booms, investors often abandon caution. During market crashes, investors often abandon logic. Emotional discipline protects against both extremes. Patience also allows you to benefit from mean reversion. Markets often overshoot both upward and downward. Extreme valuations rarely sustain permanently. Over long time frames, valuations often return toward historical norms. Patient investors can benefit from this natural correction process. Emotional discipline also improves entry quality. Instead of buying because prices are rising, disciplined investors wait for valuation justification. This improves long-term expected return probability. Patience also reduces the temptation to chase performance. Every year, different sectors or assets lead performance rankings. Chasing past winners often leads to buying near peaks. Patience allows investors to wait for better entry conditions. Emotional discipline also protects during drawdowns. Drawdowns are emotionally painful even when expected. Investors with emotional discipline maintain strategy consistency during drawdowns. Investors without emotional discipline often abandon strategy at the worst time. Patience also supports capital preservation during overvalued market periods. When valuations become extreme across markets, patient investors may reduce exposure gradually. This reduces drawdown severity during corrections. Emotional discipline also reduces reaction to market predictions. Financial media constantly promotes forecasts. Most forecasts are wrong. Emotional investors react to forecasts. Disciplined investors focus on valuation and fundamentals instead. Patience also improves reinvestment effectiveness. Dividends and earnings reinvestment compound more effectively when investors maintain long holding periods. Frequent trading interrupts reinvestment compounding. Emotional discipline also helps investors avoid revenge trading behavior. After losses, some investors attempt aggressive trades to recover quickly. This usually increases losses. Emotional discipline maintains rational position sizing. Patience also supports long-term thesis validation. Many business transformations take years to become visible. Investors who exit too early often miss long-term value creation. Emotional discipline also helps investors avoid social comparison pressure. Social media and financial forums often amplify short-term success stories. Comparing long-term strategy to short-term speculation creates unnecessary emotional pressure. Patience also improves cost efficiency. Long holding periods reduce transaction fees and market impact costs. Lower cost structure improves long-term return retention. Emotional discipline also supports better portfolio rebalancing decisions. Rebalancing often requires selling strong performers and buying weak performers. Emotionally, this feels uncomfortable. Disciplined investors follow rebalancing logic consistently. Patience also improves learning curve depth. Investors who stay invested through multiple cycles develop pattern recognition ability. Pattern recognition improves risk management decisions. Emotional discipline also helps investors accept uncertainty without paralysis. Markets will always contain unknown variables. Emotional discipline allows action despite incomplete information. Patience also reduces decision frequency. Fewer decisions often mean fewer mistakes. High-frequency decision environments increase cognitive fatigue and error probability. Emotional discipline also reduces narrative influence. Market stories change constantly. Emotional investors follow narrative cycles. Disciplined investors follow data cycles. Patience also supports strategic capital allocation. When investors are not forced to constantly act, they can wait for high-conviction opportunities with strong margin of safety. Emotional discipline also supports long-term wealth psychology. Wealth often grows slowly, then accelerates. Investors expecting fast results often abandon strategy before compounding becomes powerful. Patience also helps investors survive market stagnation periods. Markets sometimes produce flat returns for years. Patient investors continue accumulating assets during stagnation periods, positioning for future growth cycles. Emotional discipline also reduces regret bias. Investors with strong discipline accept that some opportunities will be missed. Attempting to capture every opportunity increases error probability. Patience also aligns with historical evidence. Many of the most successful investors held strong businesses for decades. Time multiplied business success into investment success. Emotional discipline also requires environment control. Reducing constant price checking, limiting financial news consumption, and maintaining long-term strategy documentation improves emotional stability. Patience also requires trust in process. Investors must believe their strategy works across cycles, not just during favorable conditions. Another critical truth: patience is not passive. It is active resistance against emotional impulses. Emotional discipline is not emotional suppression. It is emotional awareness combined with rational action. Together, patience and emotional discipline transform investing from stressful speculation into structured wealth building. Because markets constantly test emotional control, and investors who pass that emotional test consistently often outperform those who fail it repeatedly. Because long-term wealth is rarely built by reacting faster than the market. It is built by staying rational longer than the market remains emotional. Chapter 6: Independent Thinking, Escaping the Herd Trap. One of the strongest forces in financial markets is not economics. It is not data. It is not even business performance. It is human psychology. Specifically, the human need to feel safe by moving with the group. Crowds feel safe, but markets often reward those who think independently. Independent thinking in investing does not mean always doing the opposite of everyone else. It means making decisions based on evidence, valuation, and business fundamentals rather than popularity, headlines, or social pressure. The herd exists because uncertainty creates discomfort. When people see others buying, it feels safer to buy. When people see others selling, it feels safer to sell. But safety and correctness are not the same thing in markets. Independent investors ask different questions. Instead of asking, "What is everyone buying?" they ask, "What is this asset actually worth relative to its price?" Instead of asking, "Is this popular?" they ask, "Is this undervalued or overvalued?" Herd behavior often creates extreme market outcomes. Bubbles form when herd excitement drives prices far above intrinsic value. Crashes form when herd fear drives prices far below intrinsic value. Independent investors aim to avoid buying during herd excitement and avoid selling during herd panic. Independent thinking also requires emotional resilience. Being early or being different can feel uncomfortable. Markets may move against you temporarily, even if your analysis is correct. Independent investors must tolerate short-term discomfort for long-term rational positioning. Independent thinking also reduces narrative risk. Market narratives change quickly. Today's dominant narrative can collapse suddenly when new information appears. Independent investors rely on data and valuation rather than story momentum. Independent thinking also protects against confirmation bias. Herd environments often reinforce existing beliefs. When everyone believes something, dissenting analysis becomes rare. Independent investors actively seek opposing information to test their ideas. Independent thinking also improves opportunity detection. Many of the best long-term investments appear unattractive initially. Negative news, weak sentiment, or temporary business challenges often create undervaluation opportunities. Herd investors avoid these situations. Independent investors analyze them carefully. Independent thinking also requires intellectual humility. Being independent does not mean assuming you are always right. It means being willing to change your mind when new evidence appears. True independence is evidence-driven, not ego-driven. Independent thinking also protects against timing pressure. Herd investors feel pressure to act quickly because others are acting quickly. Independent investors act only when valuation and fundamentals justify action. Independent thinking also reduces performance comparison stress. Herd behavior often comes from fear of underperforming peers in the short term. Independent investors focus on long-term outcomes rather than short-term comparison. Independent thinking also requires process discipline. You must define how you evaluate investments before market emotion begins influencing perception. Predefined evaluation frameworks protect against emotional drift. Independent thinking also benefits from historical study. Market history shows repeated herd behavior patterns: railroad bubbles, technology bubbles, housing bubbles, commodity cycles. Understanding history improves recognition of herd psychology patterns. Independent thinking also reduces dependence on financial media. Media often amplifies crowd emotion because emotional stories attract attention. Independent investors use media as information input, not decision driver. Independent thinking also improves valuation discipline. When markets become excited, valuation discipline often disappears. Independent investors maintain valuation discipline even during strong bull markets. Independent thinking also requires patience. Opportunities created by herd behavior often appear during uncomfortable periods, market crashes, negative sentiment cycles, or economic uncertainty. Independent investors must wait for these periods rather than chase excitement. Independent thinking also reduces FOMO, fear of missing out. Many investment mistakes happen because investors chase rising prices to avoid missing gains. Independent investors accept that missing some opportunities is part of long-term discipline. Independent thinking also requires strong internal confidence. Confidence does not come from prediction certainty. It comes from process consistency. When you trust your process, you can tolerate temporary market disagreement. Independent thinking also supports portfolio resilience. When you avoid crowded trades, you reduce exposure to sudden sentiment reversals. Crowded trades often unwind violently when sentiment shifts. Independent thinking also aligns with long-term compounding strategy. Herd investors often rotate constantly between trends. Independent investors focus on value creation over time. Independent thinking also requires environment design. Surrounding yourself with diverse viewpoints improves independent analysis. Echo chambers reduce independent thinking quality. Independent thinking also requires continuous learning. Markets evolve. New industries emerge. Old industries decline. Independent investors update knowledge continuously. Independent thinking also improves risk management. Herd environments often underestimate risk. Independent analysis often reveals hidden vulnerabilities. Another important truth: independent thinking is lonely sometimes. Markets reward conformity emotionally, but they reward rational independence financially over long periods. Independent thinking ultimately allows investors to separate signal from noise. When crowd emotion becomes extreme, independent investors step back and evaluate fundamentals. Because markets will always produce crowds, But wealth is often built by those who think clearly while standing slightly outside them, because the crowd provides comfort. But independent thinking provides clarity. And in investing, clarity often matters more than comfort. Independent thinking also requires understanding how social proof influences financial decision-making. Humans are naturally wired to look to others when facing uncertainty. If everyone around you appears confident in an investment, your brain interprets that confidence as safety. But in markets, widespread confidence often signals increased risk rather than reduced risk. When everyone already believes something is valuable, much of the potential upside is often already priced in. Independent investors understand that popularity is not evidence of value. Popular investments can be good investments, but popularity alone is not a reason to buy. Independent investors separate social enthusiasm from financial reality. Independent thinking also requires resisting authority bias. Financial markets are filled with experts, analysts, fund managers, influencers, and media personalities. Some provide valuable insights. Others simply repeat consensus narratives. Independent investors respect expertise, but verify claims through their own analysis. Authority does not equal accuracy. Independent thinking also protects against information cascades. Information cascades happen when people copy decisions made by others instead of analyzing independently. Over time, the original decision logic may disappear, leaving only her behavior. Independent investors verify primary data sources whenever possible. Independent thinking also requires recognizing emotional contagion. Emotions spread quickly in financial markets. Fear spreads during downturns. Excitement spreads during rallies. Independent investors monitor market emotion without absorbing it. Independent thinking also improves decision timing. When markets become extremely optimistic, independent investors often reduce risk exposure gradually. When markets become extremely pessimistic, independent investors often increase exposure gradually. This is emotionally difficult because it requires acting opposite to crowd sentiment at extremes. Independent thinking also improves opportunity quality. When many investors ignore unpopular sectors or companies, mispricing opportunities often increase. Independent investors analyze unpopular opportunities carefully instead of dismissing them automatically. Independent thinking also requires structured skepticism. Independent investors question assumptions, both their own and others. They ask whether growth projections are realistic, whether competitive threats are underestimated, and whether valuation assumptions are justified. Independent thinking also reduces emotional momentum bias. Many investors believe recent performance will continue indefinitely. Independent investors understand that performance cycles often reverse over time. Independent thinking also requires clear personal investment philosophy. Without a defined philosophy, investors often drift toward crowd behavior under pressure. Clear philosophy acts as decision anchor during volatile periods. Independent thinking also improves long-term capital allocation discipline. Instead of reacting to short-term trends, independent investors allocate capital based on long-term expected value. Independent thinking also supports scenario analysis. Independent investors consider multiple possible future outcomes instead of assuming single narrative certainty. This improves risk management. Independent thinking also protects against overconfidence during bull markets. When markets rise for extended periods, many investors begin believing they possess superior skill. Independent investors remain aware that market conditions contribute heavily to performance. Independent thinking also protects against despair during bear markets. During prolonged downturns, many investors believe markets will never recover. Independent investors recognize historical recovery patterns. Independent thinking also requires emotional neutrality toward being right or wrong. Investment success is not about proving intellectual superiority. It is about making probabilistically strong decisions consistently. Independent thinking also improves long-term conviction strength. When decisions are based on independent research, investors are more likely to hold through volatility. Borrowed conviction collapses quickly under stress. Independent thinking also reduces narrative fatigue. Constantly chasing new investment stories creates cognitive overload. Independent investors focus on core principles and business fundamentals. Independent thinking also supports portfolio uniqueness. If portfolios simply mirror crowd positioning, performance will mirror crowd outcomes. Independent thinking creates differentiated positioning potential. Independent thinking also requires intellectual curiosity. Markets constantly change. Independent investors continuously update understanding of industries, technologies, and economic forces. Independent thinking also requires discipline in information consumption. Not all information is useful. Some information exists primarily to create emotional reaction. Independent investors filter aggressively. Independent thinking also supports long-term wealth psychology. Investors who think independently often avoid major bubble collapses and panic selling events. Avoiding large losses improves compounding. Independent thinking also requires acceptance of temporary underperformance. Sometimes crowd-driven markets outperform rational positioning temporarily. Independent investors must tolerate this without abandoning strategy. Independent thinking also reinforces long-term probabilistic success. Over decades, rational independent analysis often outperforms emotionally driven crowd behavior. Independent thinking ultimately allows investors to operate based on reality instead of social consensus. Because social consensus changes quickly, but economic reality changes slowly. And investors who anchor decisions in reality instead of popularity often maintain long-term advantage. Because in markets, the crowd determines short-term price, but reality determines long-term value. And independent investors focus on reality, even when it feels uncomfortable to do so. Chapter 7, Circle of Competence. Invest where you understand. One of the most underrated advantages in investing is not intelligence. It is not speed. It is not access to information. It is clarity about what you truly understand and what you don't. This is the idea behind the circle of competence. Your circle of competence represents the areas where you have genuine understanding, not surface familiarity, not headlines, not social media summaries. Real understanding of how businesses operate, how industries compete, and how value is created. You do not need to understand everything to succeed in investing. In fact, trying to understand everything often leads to shallow knowledge. Shallow knowledge creates false confidence. False confidence creates poor decisions. Intelligent investors focus deeply on areas they understand well. Circle of competence is not fixed. It can expand over time through learning and experience. But expansion should be slow and deliberate. Rushing into unfamiliar industries increases error probability. Understanding reduces emotional panic. When you understand how a business makes money, volatility becomes easier to tolerate. When you don't understand the business, price drops feel like danger signals, even if fundamentals remain strong. Circle of competence also improves decision speed during volatility. When markets move quickly, investors who understand businesses deeply can act confidently. Investors relying on borrowed opinions often freeze or panic. Circle of competence also improves conviction quality. Conviction should come from understanding, not popularity. Understanding-based conviction survives market volatility. Popularity-based conviction collapses quickly. Circle of competence also improves risk recognition. When you understand an industry deeply, you recognize threats earlier, new competitors, technology disruption, regulatory risks, or demand shifts. Circle of competence also reduces information overload. Financial markets produce enormous information volume daily. If you focus only on areas you understand, you can filter information more effectively. Circle of competence also improves valuation accuracy. Intrinsic value estimation depends on understanding business drivers, pricing power, customer behavior, cost structure, capital intensity, and competitive dynamics. Circle of competence also improves pattern recognition. When you study similar businesses over long periods, you recognize success patterns and failure patterns faster. Circle of competence also protects against hype cycles. Many hype cycles occur in industries most investors do not fully understand. When investors lack understanding, they rely on narratives instead of fundamentals. Circle of competence also improves capital allocation efficiency. Instead of spreading capital across unfamiliar opportunities, investors concentrate on opportunities where understanding provides analytical edge. Circle of competence also reduces emotional reaction to volatility. Understanding creates context. Context reduces fear. Circle of competence also requires intellectual honesty. You must admit when you do not understand something. This is difficult because markets reward confidence display, but honest uncertainty often protects capital. Circle of competence also encourages selective opportunity evaluation. You do not need to evaluate every investment opportunity. You only need to evaluate opportunities inside or near your competence circle. Circle of competence also improves long-term learning efficiency. Learning builds on existing knowledge. Expanding competence gradually improves retention and analytical depth. Circle of competence also reduces narrative vulnerability. Investors outside their competence circle often rely on simplified stories. Stories are often incomplete or misleading. Circle of competence also improves time efficiency. Instead of researching hundreds of businesses superficially, investors can research fewer businesses deeply. Circle of competence also improves error detection speed. When you understand industry dynamics, you notice inconsistencies in company reporting or strategy earlier. Circle of competence also protects against complexity illusion. Complex businesses often appear more sophisticated but may contain hidden risks. Simpler businesses often produce more predictable results when understood deeply. Circle of competence also supports long-term holding confidence. Investors who understand businesses deeply are more likely to hold through volatility, allowing compounding to work. Circle of competence also requires discipline to say no. Many attractive investment opportunities exist outside your competence. Discipline protects against unnecessary risk. Circle of competence also evolves with experience. As you study new industries deeply, your circle can expand. But expansion should always be knowledge-driven, not excitement-driven. Circle of competence also improves communication clarity. Investors who understand businesses deeply can explain investment thesis simply. If you cannot explain an investment simply, understanding may be incomplete. Circle of competence also supports independent thinking. Deep understanding allows investors to form opinions independent of market consensus. Circle of competence also reduces emotional regret risk. When decisions are based on deep understanding, outcome regret reduces even if results are imperfect. Circle of competence ultimately reinforces one powerful truth. Investing is not about knowing everything. It is about knowing enough about specific areas to make rational decisions consistently. Because markets reward depth more than breadth. And investors who stay inside their circle of competence often avoid the biggest investment mistakes made outside it. Circle of competence also changes how you approach learning itself. Instead of trying to consume massive amounts of random financial information, you begin focusing on structured knowledge building. You start asking deeper questions. How does this industry actually make money? What drives demand cycles? What causes margins to expand or shrink? Who are the real competitors, and what advantages do they have? This type of focused learning builds durable understanding. Circle of competence also helps investors avoid what looks like easy money. Some industries periodically produce explosive growth stories. Without deep understanding, these opportunities can appear simple and obvious, but industries that look simple from outside often contain complex risks that are invisible without experience. Understanding creates realistic expectations. Circle of competence also improves emotional endurance during market cycles. If you truly understand why a business is strong, you can hold through volatility with more confidence. Without understanding, volatility often creates emotional stress and premature selling. Circle of competence also improves mistake recovery speed. When you make a mistake inside your competence circle, you often recognize it faster because you understand normal business patterns. When you invest outside your circle, Mistakes can go unnoticed longer. Circle of competence also reduces dependence on external opinions. Investors outside their competence circle often rely heavily on analyst ratings, media commentary, or social sentiment. Investors inside their competence circle rely more on direct analysis. Circle of competence also improves opportunity filtering speed. Instead of evaluating every trending opportunity, you can quickly reject investments that fall outside your understanding. This saves time and reduces decision fatigue. Circle of competence also improves capital concentration quality. When you deeply understand an opportunity, you can size positions more confidently. This improves portfolio efficiency without increasing unnecessary risk. Circle of competence also reduces narrative persuasion risk. Story-driven investing is powerful emotionally, but many compelling stories hide weak economics. Deep understanding protects against narrative manipulation. Circle of competence also improves long-term career investing performance. Many successful investors specialize in specific sectors or business models. Specialization creates pattern recognition advantages. Circle of competence also requires intellectual patience. Building deep understanding takes time. Many investors try to shortcut learning by copying others. Shortcuts often create fragile conviction. Circle of competence also improves downside risk evaluation. When you understand cost structure, competitive dynamics, and demand drivers, you can better estimate worst-case scenarios. Circle of competence also improves scenario planning quality. You can imagine how businesses perform during economic stress, regulatory changes, or competitive pressure. Circle of competence also helps avoid technological hype cycles. New technologies often generate extreme excitement. Without understanding technical limitations, adoption barriers, and economic viability, investors risk overestimating value creation speed. Circle of competence also improves management evaluation. When you understand industry challenges, you can better judge whether management decisions are rational or promotional. Circle of competence also supports long-term research compounding. Knowledge builds on knowledge. The longer you study an industry, the faster you recognize important changes. Circle of competence also reduces behavioral overconfidence risk. When you know what you don't know, you naturally apply more caution outside your competence circle. Circle of competence also improves portfolio resilience. Portfolios built from well-understood investments often produce more stable long-term outcomes than portfolios built from trend chasing. Circle of competence also supports intelligent diversification. You can diversify across multiple areas of competence rather than blindly diversifying into unknown territory. Circle of competence also improves communication and reflection quality. Writing down investment theses becomes easier when understanding is deep. Clear written logic improves decision review later. Circle of competence also helps avoid complexity bias. Complex businesses often appear impressive but may hide fragile economics. Simple businesses with strong economics often outperform long-term. Circle of competence also evolves naturally. As industries evolve and new technologies emerge, investors can gradually expand understanding without abandoning core expertise. Circle of competence also reinforces emotional discipline. When you invest only in businesses you understand, you reduce panic risk during volatility. Circle of competence also helps align investing with personal curiosity. Investors often perform best in industries they enjoy studying. Curiosity improves research quality. Circle of competence also supports long-term confidence building. Confidence built from real understanding is more stable than confidence built from temporary success. Circle of competence also protects against decision overload. Limiting investment universe reduces cognitive stress and improves analysis quality. Circle of competence ultimately reinforces one of the simplest but most powerful investing truths. You do not need to chase every opportunity. You only need to act on opportunities you truly understand, because understanding creates conviction. Conviction creates discipline. Discipline allows compounding to work. And in long-term investing, consistent disciplined decisions inside your circle of competence often outperform occasional brilliant guesses outside it. Chapter 8. Continuous Learning. Compounding Knowledge. If capital compounds through time, knowledge compounds even faster. Money grows through disciplined investing. Knowledge grows through curiosity, repetition, and experience. And in long-term investing, knowledge often becomes the ultimate competitive advantage. Markets evolve. Technology evolves. Business models evolve. Economic environments evolve. But core principles, value, risk management, psychology, and capital allocation remain stable. Continuous learning allows investors to adapt to changing environments while staying grounded in timeless principles. Continuous learning improves decision quality. Every new concept you understand improves how you evaluate future opportunities. Over time, this creates compounding intellectual advantage. Continuous learning also reduces mistake frequency. Many investor mistakes come from misunderstanding business models, economic cycles, or psychological behavior. Knowledge reduces error probability. Continuous learning also improves pattern recognition. The more businesses, industries, and market cycles you study, the faster you recognize recurring patterns. Markets often repeat psychological and economic patterns, even when surface details change. Continuous learning also improves valuation accuracy. Understanding accounting, financial statements, capital structure, and business economics improves intrinsic value estimation. Continuous learning also strengthens independent thinking. The more knowledge you accumulate, the less you rely on market opinions. Knowledge creates analytical confidence. Continuous learning also improves risk detection. Learning about past financial crises, business failures, and market bubbles helps investors recognize warning signs earlier. Continuous learning also supports emotional discipline. Understanding historical volatility patterns reduces panic during market corrections. History creates emotional context. Continuous learning also improves opportunity identification. New technologies and industries create new investment opportunities. Investors who continuously learn can evaluate emerging opportunities earlier and more accurately. Continuous learning also improves capital allocation skill. Studying successful investors and business leaders improves strategic thinking. Continuous learning also improves macroeconomic understanding. Learning about interest rates, inflation, monetary policy, and fiscal cycles improves market context interpretation. Continuous learning also improves behavioral psychology understanding. Markets are driven by human behavior. Understanding fear, greed, herd behavior, and cognitive bias improves decision-making. Continuous learning also improves adaptability. Markets constantly change. Investors who stop learning often fall behind. Continuous learning also improves communication clarity. Explaining investment ideas becomes easier when understanding is deep. Continuous learning also reduces overconfidence. The more you learn, the more you realize how complex markets are. This promotes humility and risk awareness. Continuous learning also improves portfolio construction skill. Understanding correlations, diversification benefits, and asset class behavior improves portfolio stability. Continuous learning also improves time horizon perspective. Studying long-term market history improves patience and strategic thinking. Continuous learning also supports innovation evaluation. New industries often create both opportunity and hype. Knowledge helps distinguish real innovation from speculation. Continuous learning also improves crisis response. Investors who studied past crises often respond more rationally during new crises. Continuous learning also improves learning efficiency. Knowledge builds on previous knowledge. Each concept makes future concepts easier to understand. Continuous learning also improves long-term confidence stability. Confidence built from knowledge is more stable than confidence built from recent performance. Continuous learning also improves decision independence. Knowledge allows investors to form their own opinions rather than follow consensus blindly. Continuous learning also improves risk-adjusted return thinking. Knowledge helps investors focus not just on return potential, but on return relative to risk. Continuous learning also supports long-term investing endurance. Markets will challenge investors emotionally. Knowledge provides rational anchors during emotional market periods. Continuous learning also encourages intellectual curiosity. Curiosity keeps investors engaged and motivated to improve continuously. Continuous learning also improves failure recovery. Learning from mistakes accelerates skill growth. Continuous learning also requires structured discipline. Reading financial reports, studying business models, learning economic history, and following industry trends require consistent effort. Continuous learning also requires information filtering. Not all information is useful. Intelligent investors focus on high-quality, long-term knowledge rather than short-term noise. Continuous learning also compounds slowly but powerfully. Early learning may feel slow, but over years, knowledge accumulation becomes exponential. Continuous learning also aligns investing with personal development. Investing becomes not just financial activity, but intellectual growth process. Another powerful truth: knowledge compounds even if capital temporarily declines. Investors who continue learning during difficult market periods often outperform when markets recover. Continuous learning ultimately transforms investing from guessing into informed decision-making, because markets reward preparation, and preparation comes from learning consistently, not occasionally. Because over long periods, knowledge reduces mistakes, improves judgment, strengthens discipline, and increases opportunity recognition. And when knowledge compounds alongside capital, investing becomes more than wealth building. It becomes decision mastery. Because in the end, markets change constantly, but the advantage of learning faster than the market changes compounds forever. Continuous learning also reshapes how you interpret uncertainty. Most investors fear uncertainty because they feel unprepared for it, but learning builds mental frameworks. Frameworks allow you to categorize new information quickly. When unexpected events happen, prepared investors respond with analysis instead of panic. Preparation reduces emotional reaction speed. Continuous learning also improves how you interpret market noise. Markets generate massive amounts of daily data: price movement, earnings reports, macroeconomic releases, geopolitical news, analyst commentary, and social sentiment. Without knowledge, everything feels equally important. With knowledge, you learn what actually matters. Filtering improves clarity. Continuous learning also improves decision speed without reducing decision quality. Experienced investors can evaluate opportunities faster because they recognize patterns immediately. Pattern recognition is built through repeated exposure and study. Continuous learning also reduces fear of market complexity. Financial markets can appear overwhelming, but when you break markets into understandable components, business fundamentals, economic forces, psychology, and valuation, you gain confidence in navigating complexity. Continuous learning also improves long-term strategic thinking. Short-term investors often react to immediate market movement. Continuous learners think in multi-year frameworks. Multi-year thinking improves investment positioning. Continuous learning also improves probability assessment. Markets rarely produce certain outcomes. They produce probability ranges. Knowledge improves probability estimation quality. Continuous learning also improves crisis interpretation. During crises, markets produce extreme narratives. Investors who studied past crises often recognize exaggeration patterns. Historical perspective reduces emotional panic. Continuous learning also strengthens skepticism toward easy answers. Markets rarely reward simple solutions. Continuous learning builds intellectual discipline to question overly simple investment narratives. Continuous learning also improves portfolio review quality. Investors who continuously learn can analyze past decisions objectively. Learning from mistakes becomes structured improvement process. Continuous learning also supports adaptation to technological change. New industries, platforms, and business models emerge constantly. Continuous learners evaluate new opportunities without blindly accepting hype. Continuous learning also improves macroeconomic navigation. Economic cycles influence asset performance. Investors who understand economic forces often position portfolios more effectively across cycles. Continuous learning also improves communication with other investors and advisors. Deeper knowledge improves discussion quality and reduces misinterpretation risk. Continuous learning also supports long-term investing confidence. Investors who understand markets deeply experience less emotional volatility. Knowledge stabilizes expectations. Continuous learning also reduces behavioral bias vulnerability. Understanding cognitive bias helps investors recognize their own emotional patterns. Self-awareness improves decision quality. Continuous learning also improves diversification strategy design. Knowledge improves understanding of correlation behavior across asset classes. Continuous learning also strengthens intrinsic value estimation. Business valuation improves with industry knowledge and financial analysis skill. Continuous learning also improves opportunity cost evaluation. Investors can better judge whether capital is allocated efficiently or whether better opportunities exist elsewhere. Continuous learning also improves long-term capital allocation skill. Studying capital allocation history of successful businesses and investors improves strategic thinking. Continuous learning also encourages intellectual humility. The more you learn, the more you understand complexity. This reduces overconfidence risk. Continuous learning also improves investor longevity. Investors who continuously learn remain relevant across decades of market evolution. Continuous learning also reduces dependence on prediction. Instead of trying to predict exact outcomes, continuous learners build adaptable strategies. Continuous learning also improves resilience after losses. Losses become learning inputs instead of emotional setbacks. Continuous learning also improves risk tolerance calibration. Knowledge helps investors understand acceptable risk levels relative to long-term goals. Continuous learning also strengthens investment philosophy consistency. Continuous knowledge reinforces core principles during market noise periods. Continuous learning also supports multidisciplinary thinking. Successful investors often combine knowledge from economics, psychology, history, technology, and business strategy. Continuous learning also improves long-term wealth psychology. Investors who view investing as a continuous learning process often maintain discipline longer. Continuous learning also compounds faster than most investors expect. Early learning feels slow, but over years, knowledge accumulation creates exponential advantage. Continuous learning also protects against stagnation risk. Markets evolve constantly. Investors who stop learning often lose edge gradually. Continuous learning ultimately transforms investing from reactive behavior into proactive preparation because markets constantly change. But investors who continuously improve understanding change faster than markets do. And over long periods, the ability to learn faster than the environment changes becomes one of the most powerful investing advantages possible. Because capital compounds, but knowledge compounds first. And knowledge determines how capital compounds over time. Continuous learning also changes how you experience time in investing. Most investors focus on short-term performance cycles, weeks, months, sometimes a year. Continuous learners focus on decade-level skill development. Over decades, knowledge advantage compounds faster than short-term performance fluctuations. Short-term performance is noisy. Long-term knowledge is durable. Continuous learning also improves your ability to recognize second-order effects. Many investors understand first-level impacts. For example, interest rates rising can reduce stock valuations. But continuous learners also think about secondary impacts, how interest rates affect consumer spending, business borrowing costs, currency strength, and capital allocation decisions. Second-order thinking improves strategic positioning. Continuous learning also improves investment adaptability. Markets constantly introduce new asset classes, financial instruments, and business models. Continuous learners can evaluate new opportunities without blindly accepting or rejecting them. Continuous learning also improves capital protection skill. Learning about historical financial failures teaches risk management principles. Studying failed companies often teaches more than studying successful ones. Continuous learning also improves macroeconomic resilience. Investors who understand monetary policy, fiscal policy, and economic cycle behavior often respond more rationally during economic transitions. Continuous learning also improves valuation context awareness. Valuation multiples change across economic environments. Continuous learners understand when high valuations may be justified and when they signal excessive optimism. Continuous learning also improves industry disruption detection. New technologies often disrupt old business models gradually before collapse becomes obvious. Continuous learners often detect disruption signals earlier. Continuous learning also improves management quality evaluation. Studying management decision patterns across companies improves leadership evaluation skill. Continuous learning also improves behavioral finance awareness. Understanding cognitive bias helps investors avoid emotional mistakes like loss aversion, confirmation bias, and recency bias. Continuous learning also improves risk-adjusted decision thinking. Instead of chasing highest potential return, continuous learners evaluate return relative to risk and probability. Continuous learning also improves long-term confidence stability. Investors with deep knowledge trust their analysis during volatility more than investors relying on recent performance trends. Continuous learning also improves capital allocation patience. Knowledge helps investors recognize that true high-quality opportunities appear irregularly, not constantly. Continuous learning also improves crisis opportunity recognition. Market crises often create extreme mispricing. Continuous learners often recognize crisis-driven opportunity faster. Continuous learning also improves long-term strategy durability. Markets evolve technologically, politically, and economically. Continuous learners evolve strategy accordingly while maintaining core principles. Continuous learning also improves interdisciplinary thinking. Investing is not purely financial. It involves technology, sociology, psychology, geopolitics, and innovation cycles. Continuous learning also improves risk scenario imagination. Investors who study history and business cycles often imagine potential risks earlier than others. Continuous learning also improves decision documentation quality. Writing investment reasoning improves clarity and learning feedback loops. Continuous learning also improves self-correction speed. Investors who continuously learn adjust faster when assumptions prove wrong. Continuous learning also improves uncertainty tolerance. Knowledge reduces fear of unknown variables. Continuous learning also improves capital compounding sustainability. Better decisions reduce catastrophic losses. Avoiding catastrophic losses protects compounding. Continuous learning also improves portfolio evolution quality. Investors gradually improve portfolio construction skill through experience and study. Continuous learning also improves intellectual independence. Knowledge reduces reliance on market sentiment or authority figures. Continuous learning also improves opportunity patience. Knowledge helps investors understand that missing mediocre opportunities is acceptable. Continuous learning also improves investment philosophy clarity. Clear philosophy improves consistency across market cycles. Continuous learning also improves failure interpretation. Failures become learning events rather than emotional setbacks. Continuous learning also improves long-term wealth psychology. Investors who focus on learning often focus less on daily price movement. Continuous learning also improves future opportunity readiness. Investors who continuously study are prepared when rare high-quality opportunities appear. Continuous learning also improves life decision quality beyond investing. Financial thinking overlaps with business strategy, risk management, and long-term planning. Continuous learning ultimately creates cumulative advantage. Each new concept improves how future concepts are understood, because investing is not static knowledge. It is evolving knowledge applied to evolving markets. And investors who stop learning eventually fall behind, not because they became less intelligent, but because markets continued evolving. Continuous learning transforms investing from prediction game into preparation discipline, because markets will always change. But investors who continuously improve understanding change faster. And over long periods, those who adapt faster often outperform those who simply react faster. Because capital growth follows decision quality, and decision quality follows knowledge depth. And knowledge depth grows only through continuous learning. And that compounding of knowledge, judgment, and discipline is what ultimately separates temporary market success from long-term investing mastery. If you remember nothing else from this audiobook, remember this. Markets will always be emotional. News will always be dramatic. Prices will always fluctuate. But true investors stay logical. You now understand that investing is not about prediction. It is about preparation. It is about discipline. It is about emotional control. You don't need to be the smartest person in the market. You just need to be the most rational person when others lose control. You don't build wealth by reacting to headlines. You build wealth by following principles, by thinking like an owner, by demanding margin of safety, by using volatility instead of fearing it, by diversifying intelligently, by staying patient, by thinking independently, by investing within your understanding, by learning continuously. And one day, if you stay consistent, you'll look back and realize something powerful. You didn't just grow your money. You grew your decision-making. You grew your discipline. You grew your mindset. And that is the real return. Because in the end, the market rewards not the fastest, not the loudest, not the luckiest, but the most consistent. And now the question is not whether the market will test you. It will. The real question is, will you stay intelligent when everyone else becomes emotional?